What is a mortgage note? Well, for a homeowner, a mortgage note is debt. It's the commitment to pay principal and interest payments every single month or you lose your home through the foreclosure process. But that financing with a bank is actually an asset for the bank, and an asset that can be transferred to third parties, to other companies, to investors. And that's what this channel is all about, teaching investors in real estate how to buy mortgage notes for your own portfolio to become the bank, to be the recipient of principal plus interest payments, and having that leverage to foreclose if your mortgage note is not paid by the homeowner. So in this video, I want to show you exactly what buying a mortgage note looks like, all of the documents that come into place to create a secured lien attached to a property. And it all starts with the collateral file. This is what you get when you buy a loan, a file full of documents. Some of these documents are recorded in the public record, like the mortgage and the assignments, and other documents are between the lender and the borrower, like the note and the allonge. So I'm going to show you those documents here, starting with the note. In this case, we've got what's called an adjustable rate note. You might see promissory note, you might see home equity line of credit, but at the end of the day, the note is the document that includes the balance owed, the monthly payment amount, the term, which is how many monthly payments are required, as well as the dates, the first payment date, the maturity date, and the details around the interest rate that is being paid. In this case, it's an adjustable rate note from back in 2004 that has an interest rate between 9 and 11.75%, but this could be any number of different terms based on the underlying note. When you go to the end of a note, if it's been transferred before, you'll see what's called the allonge, or the endorsement of the note. And that is the second important document in these 4 critical documents in a mortgage note file. The allonge transfers the note from one party to another. We can see at the top here, this was Homecomings Financial Network Inc. loan. That's the lender. And when we scroll to the bottom, we can see that the lender, Homecomings Financial Network, transferred to Residential Funding Corporation. We can see that then Residential Funding Corporation transferred it again to JP Morgan Chase Bank. So these allonges show that Homecomings sold the loan to Residential Funding, who sold the loan to JP Morgan Chase. And this loan actually was transferred again to an investor in the secondary mortgage market through another allonge, which I don't have pictured here, which was done on a separate page, transferring it then from JP Morgan Chase Bank as trustee to their LLC. The other most important piece, because the promissory note or adjustable rate note in this case just details the terms of repayment, is the mortgage, which details what will happen if these terms are not met by the borrower, because the mortgage secures the note to a property so that if it is unpaid, the lender can foreclose. So you can see the same thing here. We have the lender's information as well as the borrower's information. And as we scroll through here, we can see that the amount matches, but then the rest of this information on the mortgage is different. And it's all around the borrower's threat of foreclosure if they don't pay. So you can scroll through here and kind of skim through. If you've ever signed a mortgage before, you know these documents can get very long, and they are all designed around protecting the lender. All of the terms of a mortgage are stacked in the lender's favor. And when you buy a mortgage note, you become the bank, you become the lender, and you take advantage of all of the provisions and terms that are listed in this contract that the borrower signed. And just like the note is transferred through an endorsement or an allonge, those stamps we saw, a mortgage is transferred through an assignment. This assignment reflects what this allonge says. It's the same thing, but transferring the mortgage instead of transferring the note. Residential Funding Corporation transferring to JP Morgan Chase. The assignee is the Bank of New York Mellon, JP Morgan Chase, and the assignor is Residential Funding. So just like this allonge transfers from Residential Funding to JP Morgan Chase, this assignment transfers from Residential Funding to JP Morgan Chase. And there's a chain of assignments, but each one of the allonges has a corresponding assignment that transfers the ownership of the security instrument. So just like a note is transferred through the allonges, a mortgage is transferred through the assignments. And that is what makes up a complete collateral file: a note and its subsequent endorsements or allonges, and a mortgage and its subsequent assignments. Now, one final thing to mention here: the mortgage and the assignments are recorded in public records. So if any title company researches this property, or the borrower goes to sell the home or refinance their mortgage, the title company will find the mortgage and the assignments transferring it in the public records so that the lender can then get paid on the promissory note. However, the promissory note is not recorded in public records, and that remains part of the lender's collateral file. And that is the 4 documents that make up a mortgage note. To give you a little bit more information about the other side of this business, investing in debt, because nobody is talking about the revolution happening in real estate, where regular investors can earn great profits while helping homeowners that the banks have failed. Join the movement and start your journey into note investing at FIXnotes.com.